Hi guys, so today we're going to look at inventory valuation and we're going to pay close attention to three specific methods that we use to evaluate inventory. And those three methods are FIFO, LIFO, and AVCO. So we'll sometimes ask the question, well, why do we need to do inventory valuation? Well, let's say you're the owner of a retail company. You'd need to know about the cost of the products that you would be selling, the cost that you pay to purchase the products before you resell them. So having detailed information about the cost of these products would certainly help you. When we do inventory valuation, we get to see the changes in price per unit of inventory purchased. So in other words, we'd get to see if every shipment of the product, if the cost is the same per unit or whether the price changes. It helps us evaluate the cost of goods sold, which is a very, very important part of our income statement. We always want to keep the cost of our goods sold low so that we can maximize profits. And certainly, it helps us in setting prices. This information would be vital to help us to set a price that would appeal to our customers, but it would also make the company achieve a profit. So a company would choose the best inventory costing method that would work best for them. There are 4 types of inventory valuation methods that a company can choose from in order to use. These are 1. Specific unit cost, 2. FIFO, which stands for first in, first out, 3. LIFO, which stands for last in, first out, and last, AVCO, which stands for average cost. We are going to be paying close attention to FIFO, LIFO, and AVCO because these are the 3 that are required for CSEC. Let's take a look at the FIFO method of inventory valuation first. This method, the cost of goods sold is based on the oldest purchases. In other words, the first stock that comes into the warehouse is the first stock that goes out of the warehouse. First in, first out. The first set of stock that comes into the warehouse is the first set of stock that is sold out of the warehouse. So in a nutshell, the company sells their oldest inventory first. For example, let's say we purchased 5 units of stock at $20 each. Then, sometime during the month, we purchased again 4 units of stock at $22 each. Under the FIFO method of inventory valuation, when we're about to do a sale, the first inventory that came in or the oldest stock would be sold first. So therefore, if I have to sell some units of stock, I would first sell from the 5 units that was purchased, then I would sell from the 4 units that was purchased. First in, first out. Now let's take a look at LIFO. So essentially, LIFO is the opposite of FIFO. Whereas in FIFO, the first set of inventory is the first to go out. In LIFO, the last set of inventory or the newest inventory is the first to go out. So again, our last purchase would be the first out of our warehouse when we're going to make a sale. Using the same example as the previous method, if we purchase 5 units at $20 each, and then later in the month we purchase 4 units at $22 each, under the LIFO method of inventory valuation, when we're going to make a sale, we're going to sell the last units first, which will be 4 units at $22 each. Then we're going to sell the 5 units at $20 each. The final method of inventory valuation is AVCO, which stands for average cost. Under this method, the business computes a new average cost per unit after each purchase. So let's use the same example as before. If the company purchases 5 units at $20 each, the total value of our inventory on hand would be 5 multiplied by 20, which is $100. Then later in the month, we purchase 4 units at $22 each, giving us a total value of $88 a month. Now that we've made our second purchase, we now have to compute the average cost of our inventory. How do we compute the average cost of our inventory? In order to do so, we need to calculate the total number of units of inventory. That will be 5 plus 4, so we now have 9 units of inventory on hand. Then we need to compute the total value of inventory on hand, which would be $100 plus $88. And that will give us a total value of $188. Now, if we have 9 units of stock that is worth $188 in total, then the average cost of our inventory would be $188 divided by 9 units. And that will give us an average of $20.88 per unit of our inventory. So to close, we will just reiterate the 3 inventory valuation methods again. First in, first out. First cost into inventory are the first cost out to cost of goods sold. Last in, first out, which is the opposite. The last cost into inventory are the first cost to cost of goods sold. And average cost, which is the average cost per unit, which is determined by dividing the cost of the goods available for sale, that's the total value of our stock available for sale, by the number of units that we have on hand. I hope you enjoyed this tutorial. Any questions or concerns, please feel free to leave a comment in the description box below or head over to my Instagram and Facebook pages. Don't forget to like, share, and subscribe.